Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are mixed here. The NASDAQ is the worst performer. Our very own Jared Blickery is breaking down all the moves. Jared.
Another nasty day for tech. We're going to dig inside that in a second here. Let's check out the Wi-Fi Interactive, where we see kind of a mixed market right now. Here's the Dow. It's up 336 points, or 0.7%. And you can see we're back in the green. Been there most of the day. Briefly dipped red during the 1 p.m. hour. And here's the NASDAQ Composite. That's down 1%, just a little bit more than that. Been red the whole day. And the S&P 500 down just 0.2%, trying to claw its way back to that unchanged line right there. And let's check out the S&P 500 equal weight here, because that's been green all day. That's where every stock gets one vote, not just weighted towards some of those bigger names like Apple and Nvidia. And then we got the small caps. Here's the S&P 600 up over 1%, and the mid caps up almost 1%. So some of the smaller names doing well, but not the micro caps. We're going to look at the CRSP microcap index there. And so all together, big and small, we got a mixed market here. But what is surging for the third straight day is the Dow Transports. They are up 2.5% over the last 3 days, up nearly 8%. They took off after that ISM manufacturing report on Monday morning, and they have not looked back. Now here's the VIX. VIX getting a little bit elevated here at 19, up from 14, 15 a few days ago. Not quite to 20, which is where you start to raise some eyebrows, but that's something we're going to monitor. And then the 10-year Treasury yield, that is just about flat at 4.28%. We'll check out the 30-year as well. That is up 1 basis point to 4.92, inching closer to that big 5% level that sometimes spells trouble for stocks. And then here's the US dollar index. We're going to call that roughly flat after being red most of the day. Now here's the large cap sector action. It is a story of materials. That is where you're going to find a lot of your gold and silver miners, along with other things, chemical companies as well. But materials have emerged as one of the best performing sectors of the year. They are leading up 2.4%. Real estate up a bit less than that. And then energy, your best performer of the year, up over 15% year to date, up over 1.5%. Then healthcare, staples, financials, all of those up more than 1%. So all in all, the S&P 500 doing great, except for the large caps and tech. So let's take a peek inside the NASDAQ 100, where we see Tesla down 3%, Broadcom down 4%, Micron down 9%, and if I go to our chip board, you're going to see AMD down 16%. So a lot of red on this board, not totally red, but on a flip from that, we got software where we're seeing a lot more green. So once again, the bifurcated tech trade where we got software and chip stocks going in opposite directions, although the software sector has a lot more to recoup. And on that note, I'll send it back to you, Josh.
All right, Jared, thank you. Well, the sell-off in tech not showing signs of slowing down, both hardware and software names under pressure. But the Dow is showing some signs of life, and that outperformance highlighting the broadening. My next guest is watching closely. Join me now. We got Andrew Pauker, Morgan Stanley, Senior U.S. Equity Strategist. Andrew, it is great to see you. So let's start with your year-end target here, Andrew. You're constructive, my friend. You got 7,800 for the SPX. You see earnings growth of 17% this year. Maybe start there. That earnings growth you see, Andrew.
Yeah.
Narrow, broad. What do you forecast?
So we've forecast a broad 17% earnings growth this year, and the main driver, Josh, is the return of positive operating leverage. So we've seen over the last couple of years is that cost structures have compressed really since 2022. Mm-hmm. And that's mainly a result of a second derivative deceleration on compensation expense. At the same time, we started to see pricing power and top line firming. And that's a powerful setup for earnings growth for the average stock, for cyclical areas of the market, and for small cap equities. I think holistically, this is the best earnings setup that we've seen since 2020 into 2021.
What do you make of this market, Andrew? Because there had been a narrative that, big tech had to hold in there or the market would fall apart. You heard that storyline. Big tech has been under pressure, but it sounds like, folks, they're finding new trades, new opportunities. And I'm just curious what you make of that trend.
Well, I mean, the broadening is playing out even on a day like today, as you pointed out at the open. 70% of S&P members are up on the day. We're seeing areas like transports, like housing-related stocks, certain pockets within consumer, regional banks that are not just outperforming the broader market, but are up significantly in absolute terms. And that to us is a broadening that's playing out. And I'll give you probably the best piece of evidence that we have from our perspective that this fundamental story is ongoing, which is that earnings growth for the median stock in the Russell 3000 right now, so broad index, is up 13% on a year-over-year basis. That's the best growth that we've seen in 4 years. So this is a leadership base that is broadening beyond sort of the prior mega cap leaders.
How would you characterize valuation here?
So valuation is extended from a historical standpoint, no question about that. I think there's a few variables to consider for why valuation can stay supported around current levels, around 22 times forward earnings. So number one, the median stock in the S&P trades at a 3-turn discount to the cap-weighted index. So if we're right on a broadening in leadership playing out this year, driven by that positive operating leverage dynamic, that margin dynamic, we should see a catch-up from the median stock valuation to the cap-weighted index valuation. Number two, for all the talk about mega cap tech market multiples and valuation, the Mag 7 forward P has actually not expanded since the beginning of 2023. We can go back to the end of 22 when ChatGPT came out, actually didn't expand since that period. And then lastly, a back test that we've run is historically when earnings growth is above the long-term median, so above 8% on a year-over-year basis, and the Fed funds rate is down on a year-over-year basis, both of which are our house views for this year, the market multiple on the S&P expands 90% of the time, 90% of the time. So I think that those are some counters to the idea that valuation in and of itself is elevated.
In terms of where you see opportunity, Andrew, small caps and consumer discretionary, what's the common theme or themes that explain why those two would work in this backdrop?
So for consumer discretionary, we like it on the good side in particular. We're starting to see unit demand improvement. We're starting to see pricing improvement. The relative earnings revisions for that space has improved quite a bit over the last several months. In addition to that, we have a fiscal tailwind this year, $65 billion fiscal tailwind. A lot of that's going to hit in the first quarter of 2026. Household balance sheets are strong in aggregate, and that's a trade that's out of consensus from a sentiment and a positioning perspective. And then on small caps, look, the S&P 600 small cap index is seeing 10% earnings growth right now. That's the best growth that we've seen since 2022. It's up from negative 5% 1 year ago. And then we talked about valuation before, Josh. That S&P 600 small cap index trades at a 7-turn discount to large cap equities in the S&P 500.
You talk consumer discretionary. Consumer staples is interesting. I want to get your take on this, Andrew. Some folks said, Jared pointed out at the top how folks have been piling in there year to date. And I've heard some investors say, well, that's a defensive sector. And they almost say the fact that it's working so well is kind of like a yellow flag to them. Is that how you see it or no?
So, I mean, I would say from a relative performance standpoint, consumer discretionary, particularly on the good side, has been hanging in there from a performance perspective this year. Staples to us is a more defensive cohort. So we would gear more pro-cyclically towards consumer discretionary. That's where the earnings revisions have been stronger, and that's where the fiscal tailwind is likely to play through as well in our view.
Tech under pressure. I had another investor sitting in that seat, Andrew, this week, and he said he's avoiding tech. Even though it's been a bit beat up here, he says too richly valued still. Is that how you see it?
So we see it a little bit differently. The fundamental setup for large cap tech, whether you're looking at the tech sector or Mag 7 or NASDAQ 100, remains intact from our perspective. Those stocks in aggregate have been trading with the revenue revisions, and what do the revenue revisions just do? Just accelerated to 20-year highs. At the same time, you have the valuation dynamic that I mentioned before. The forward multiple for that cohort has not expanded since the beginning of 2023. So there really isn't the valuation excess. It's been all a forward earnings story. I would also mention that the market is still rewarding high capex to sales behavior, not just for the tech sector, but for the broader S&P 500. And so that, I think, benefits the AI enablers and the hyperscalers. And then one last thought there, we're also focused on the AI adopter trade. So we have about 40 basis points of margin expansion in our 2026 earnings numbers from the AI adoption momentum that's going on. And a lot of that's concentrated in services areas of the equity market, financial services, consumer services, healthcare services. And our analysts have done a lot of work at the stock level to identify what those names are.
In terms of sectors you would be underweight, Andrew, what would those be?
So it would be the defensive cohorts that we talked about before. So we're officially underweight consumer staples and real estate. I think that there are some bifurcations in other sectors as well. Like, for instance, within consumer discretionary, we've voiced a goods over services preference. The reason is that we're starting to see wallet share shift from services to goods for the first time in 4 or 5 years. So remember, after COVID, massive overinvestment or overconsumption cycle in terms of the goods economy, consumers were stuck at home with excess savings. And so now that's starting to flow the other way, where we went to services, now we're going back to goods.
As for the Fed, you say the nomination of Wurster, you point out, Andrew, say it doesn't impact the rate path near term. I think we have odds from Polymarket we can actually show on that, kind of a split they show between 2 and 3 cuts over there. Curious to get your take though, Andrew. What's the house view? How many cuts in 2026?
So the house view is 2 cuts still in the back half of this year. I think the generally muted reaction to the worst nomination in and of itself makes sense to me, as does the cyclical leadership. The early tell there was from early December to mid-December, when Wursтер's odds went up for the first time, cyclicals led the market, small caps continued to lead. It was economically sensitive areas. So the reaction that we've seen over the last few days very much fits with what happened during that period. And then the other questions are around the balance sheet.
Yep.
And there our economists are of the view that changes to the balance sheet under a Wurst-led Fed likely come in a deliberate fashion over the next year or two.
If you did shrink the balance sheet, can I just, before we get out of it, you remove that liquidity, what would that mean potentially for the stock market?
Well, I mean, for certain liquidity-sensitive asset classes and pockets of the equity market, like a speculative growth type of pocket of the equity market, it would have more of an impact. One thing that I want to highlight, though, that I think actually matters the most from a near-term liquidity perspective, so the Treasury General account has been built back up, and that's been sort of sucking liquidity out of the system. Over the next couple of months, as tax refunds are paid out, that will actually be a positive liquidity impulse. And I think will ultimately be more important for the market in the near term and those liquidity-sensitive asset classes and pockets, more so than the Wurst news in and of itself.
Andrew, great to have you on the show today, especially on set. Thank you.
Thanks for having me, Josh.
And you can scan the QR code on your screen to check out Yahoo Finance's Predictions Market Hub, powered by Polymarket. Coming up, battle between banks and crypto companies is heating up. We're digging into what the fight is all about. That's straight ahead. For a look at the trends driving markets and investors, let's turn it over now to Yahoo Finance's executive editor, Brian Sozzi, who is joined by the CEO of Charles Schwab.
All right, thanks so much, Josh. Appreciate it. Rick, good to see you again here, live in the flesh, Yahoo Finance headquarters. So it's been a busy, month and a half, month and 2 weeks start for markets. What have you seen with your customers on the Schwab platform?
Well, they're very engaged. We thought they were engaged last year. In 2025, trading was up about 30% last year versus 2024. They've been even more engaged in 2026, and for good reason. There's been a lot happening in the market, whether it's been Bitcoin and some of the unwinding of that trade, certainly some of the AI stocks and software, gold and silver. There's just been a lot of themes in the market, and our investors have been very engaged in that.
I always live in two different worlds when I talk to you. One, I'm asking you for thoughts on the market, but you're like this here with Schwab. So I got to ask you about the business. But I do have to ask you about, commodities. Like we've seen this major run up. Do you view commodities like a gold? Is that still a safe haven for investors, you think?
I certainly think gold, many people think about it as a safe haven and as an inflation hedge. But the most fascinating thing to me about the recent market activity is that Bitcoin's always been thought of as digital gold. Or if you ask someone why they own it, they say it's digital gold. Yeah, and in the last 12 months, you've seen gold go up 100%, silver, I don't know, it's up probably 200 or 300%, and of course Bitcoin's down 30, 40% off the highs. So that's been a little bit surprising to see. Other commodities, I think oil's pretty interesting. I always tell people when they say, "Hey, Bitcoin's 75,000," you can go buy a lot of barrels of oil for one Bitcoin. So we'll see how the commodity markets shake out, but a lot of interesting things happening for sure.
Since you took over as CEO, you and I have always talked about what you want to do in cryptocurrencies and what you don't want to do. But you have to look at the past month of activity as it pays to be methodical in this space. As a Charles Schwab?
Well, I think for us, we want to offer what our clients want, and our active traders do engage in digital assets, and they own a lot of the crypto via ETPs today. They're exchange traded products, so they're invested. But it's still a relatively small holding for our clients. We have less than 5% of our clients that have some sort of crypto holding, and typically it's less than 1% of their portfolio. So when you do 4% times 1%, there's not a lot held yet at Schwab. We'll see how it goes, but if our clients want it, we need to give it to them.
Are you more hesitant to making a bigger push into crypto given where prices and the volatility that's come back to the space?
Well, I think we want to take the long-term view on crypto. There's a lot around crypto. There's Bitcoin, which again people view as this digital gold. Then there's all these digital assets that are sort of utilities, and if tokenization picks up and people are using the protocols on top of the blockchains and the gas fees associated with those create value in some of these digital assets. And we need to have a platform so people can participate in that over time. So we want to participate. I think you've got to take a long-term view on this. We'll see how it plays out, but it's 50% volatility in Bitcoin. Anything can happen. You need to expect that.
But isn't it good? I mean, at least for today, your stock is up year to date. Robinhood is down over 40%. Coinbase is under pressure. Isn't it just, wow, okay, I'm glad I'm not really even involved in here.
Well, I always think in markets, whatever your perspective is on Bitcoin and whether it's going to go up long term or not, I think it's really healthy to have pullbacks in markets because you exchange the holders of that from so-called weak hands, which might be in it for their friend bought it, they feel like they need to own it, to strong hands who are in it for a particular reason. And I think in periods like this where you're getting people flushed out of the market, you tend to end up with stronger holders. So that's probably a good thing for the asset longer term, but certainly for us as a business, this kind of environment where stocks are doing well, we're all about getting people invested in markets, the power of compounding, helping them have a plan, stick to that plan over time, and live their best financial life. And so in a market where you see equities being the backbone and fixed income doing well, that plays right to our sweet spot.
I'm coming to you to be the voice of reason here on prediction markets. What do you think about this landscape?
Here's what I think. I think there's three elements of prediction markets, and I think two of them to me make sense for investors, and one I don't think makes sense. And the first is that the prediction markets offer you insights into the probability of different events. And I think as an investor, that information is good to know about, and you want to be aware of it. And so at some point, we'll make that available on our website. Of course, you can go to Kalshi or Polymarket today and see it. The second is that there are prediction markets linked to financial markets. So if you want to take a position on what's going to happen to the inflation report, I think you can argue that's related to your portfolio, might accentuate or hedge a position that you have. And again, that's something I think makes sense in the context of investing. The third one, which we really struggle with and is counter to our mission, that's all the gambling, sports gambling. And if you look at where the volumes are, it's 95% sports gambling. And our mission is to make people better off. And people generally don't get better off in their financial life via gambling. So that's something we're hesitant to do. We'll leave that to the gambling firms. We'll leave it to the FanDuels and the Robinhoods and others that are positioned themselves as gambling firms.
Is all of it gambling? Even if you want to bet on what the inflation print may or may not be, isn't it all just random guesses? I
think that is not an unfair statement. I think you can at least, with an employment report or an inflation report, say, I have a lot of bond exposure. If this inflation report comes in hot, I'm going to get hurt, so I want to hedge myself. So I think you can make that case, but I don't disagree. It's still, there's an element of gambling in both of those.
How could Schwab do something like this better and safer?
Well, I don't know that you can make sports gambling safer.
Well, even outside of that, even like
the prediction markets?
Yeah, prediction markets.
Well, I think the main thing is to give our investors the information. One of the great things about our platform is we try to do everything to put information at our clients' fingertips that are going to help them make the right decision. We start with a financial plan, a long-term perspective on what it's going to take for them to succeed. And then as they're making their investment decisions, we give them all kinds of research on equities, on markets, we provide live coaching. We have 1,000 traders every day that are picking up the phones, talking to our clients to help them make their decisions. So everything we do is geared towards getting them in the right spot. And if we were ever in prediction markets, we'd have to do it along those lines.
I think back past 6 months, S&P 500, 7,000.
Yeah.
Walmart hit $1 trillion market cap yesterday. There's so many, I think, next generation investors entering the market, like young investors, that next generation. How do you think these sub 25-year-olds are going to influence the markets over the next decade?
First of all, it's great to see the influx of new investors. Gen Z investors are 41% more likely to invest before the age of 21 than the prior generation. So young investors are getting invested, and they're getting invested heavily. They make up a third of our new household, our new clients of the firm last year were Gen Zers. We've brought down the average age of our client by 10 years in the last decade.
Wow.
We keep getting younger and younger because we're winning with the young client. And what they love about Schwab is there's no trade-offs. If they want to talk to someone and get help, they can. If they want to walk into one of our branches in New York City here or another neighborhood across the country, we're there for them, and we still have all the digital capabilities and the platforms that you would expect that young people love to engage in. So we want to be here for them, and I just love that they're getting invested early.
I wish I was young again, Rick, because I would actually own some stocks. I own no stocks before the age of 25. So depressing.
Well, you know what? You're doing great now, and
Thanks,
you're still a young man, Brian. Come on.
Well, I don't know about that. Rick Wurster, good to see you. Charles Schwab CEO, thanks. Appreciate it coming down.
Thanks for having me on.
All right, Josh, back to you. Go buy some stocks, Josh.
Thank you, Sazi. Ford reporting decline in sales in the U.S. as EV sales take a turn. Yahoo Finance's Praz Sumarani join us now with the very latest. All right, Praz, let's dig into these numbers, my friend. So Ford's U.S. vehicle sales, they drop about 5% in January. The EV sales, though, Praz, I mean, that collapses. It looks like about 70%, Praz. I mean, walk us through this. Is this Ford specific? It's a Ford story, or no, this tells us something broader about the EV market?
So, traditionally for automakers, including Ford, January is kind of a down month, right? They trend a little bit, trend a little bit lower after Q4. But this January was down, I think you said 5%, right? So part of that is definitely EVs, Mustang Mach-E and F-150 Lightning, both down a lot. The Lightning has been canceled as of now, and it will come back later on, probably as a E-Rev, as they call it. But I think a big part, Josh, and we touched on more EV stuff, is that the Ford sunsetted two popular models, the Ford Escape and Lincoln Corsair, and that really hit their January numbers, right? So it's not all EVs, but definitely part of it.
Just remind us, Praz, what is Ford's broad EV strategy right now, and how does it sort of, compare, contrast to rivals?
So, what happened in the near term, right? You alluded to it. Is there a broader EV problem? And that's definitely the loss of tax credits, things like that, pull a lot of that EV demand forward. So, we also, that's not just Ford, right? So Hyundai and Kia also got their EV sales hit. But looking ahead, for the near term, if they want to boost sales, they got to look at incentives, maybe things like free charging or home chargers to gin up sales. But long-term, Ford is working on a universal EV platform that's going to be for smaller, cheaper EVs that they say will be profitable, when those cars come out, probably in 2027, 2028. But remember, there's also reports that Ford is talking to Chinese OEMs like Xiaomi to build EVs in the U.S. So, there's a lot of smoke there, and you might actually see that in the coming years.
So we talk EVs. What about the gas trucks, the Ford SUVs, Praz? How are they holding up?
I mean, gas trucks are doing pretty well, right? So look at Bronco up nearly 20%, Explorer up 30%. F-Series trucks down 18%. It's unclear if that's due to the Novelis aluminum plant fire and that sort of hit their production or just seasonal reasons. But I want to know, in addition to trucks, Mustang sales booming up 50% in the winter. Again, a little unclear, but Ford will take it, right?
Broncos and Mustangs. There it is. Praz, thank you.
I'll see you.
Sticking in the auto space, Uber reported earnings this morning while fourth quarter revenue did top estimates. The guidance weighing on the stock today. Earlier on Yahoo Finance, Julie Hyman broke down the results with Wedbush's Scott Devitt. Take a listen.
The results, the quarter was strong. I mean, this is a company that's growing bookings 22%, revenue 20%, EBITDA 35%. Guidance was in line. I think the first kind of issue that I would highlight is the company's not beating expectations the way that it was, coming out of the pandemic anymore. They're kind of reporting inline results, but those results are quite good. Which brings to this broader topic of what the real issue is, which is how Uber's business model evolves as AVs become a larger percentage of total rides in coming years. And I think Uber has a view, which is that it'll be very fragmented and that Uber will very much participate, in the growth of AVs over time. Our view is a little bit different, which is that supply will become much more concentrated and potentially controlled by vendors like Waymo and Tesla that operate outside of Uber's ecosystem. And that could be problematic in terms of taking market share away and in terms of degrading Uber's overall take rate. So it's a kind of it's a tug of war back and forth between bulls and bears on this stock around the very good short-term results and that longer-term risk.
And the company, this new CFO appointment they made, Balaji Krishnamurthy, who had been an internal hire, who they've now promoted, he seems to be an autonomous vehicle guy, or he's been a big proponent of that strategy at the company. Is there a way for Uber to participate here, or do you think just by the very nature of and structure of the company that the autonomous vehicle operators are going to be the winners here?
So it's a topic that would take hours to fully go through, but I'll distill it down to 30 seconds, which is that it comes down to whether one believes that there will be autonomous vehicles provided by an endless number of vendors, like all OEMs over time, and things like NVIDIA technology will be integrated into vehicles. I think to me that's a little bit far-fetched. I think the technology itself is the differentiator, which is why we're seeing purpose-built vehicles like Waymo, and then very unique technology companies like Tesla building capabilities in. And so it comes down to this kind of fragmentation discussion, which would lend itself to supply fragmentation and more inventory going into Uber's system, and supply concentration, which is the Waymo, Tesla, Baidu, thesis that would extract inventory away from Uber's system. And it's really as simple as that, although it's a lot more complex. But because nobody knows, it's just like this broader topic of tech stocks right now. Nobody really knows how a lot of these topics are going to play out. And so it's really the sentiment at the market at any given point in time that's driving the stocks.
Coming up, we're looking at one of the winners in tech today, Apple. What's driving that action? Plus a look at other top trending tickers that's trading. Investors wiping out nearly $500 billion in the crypto market this past week. Bitcoin down roughly 40% from its October highs. Drawdown raising questions about leverage, liquidity, and whether this sell-off is more than just a normal correction. Joining me now, we've got Patrick McHenry, Yahoo Finance Vice Chairman and former Chairman of the House Financial Services Committee. And we got Ian DeBode. He is President of Yahoo Finance. Gentlemen, welcome to you both. Ian, I will start with you. You had your big summit, the Yahoo Summit in New York this week. What was sort of front and center? What were folks talking about, Ian?
Yeah, the energy in the room was very high. The topic was primarily tokenization. And really 2026 is the year that people expect tokenization to fully enter into the mainstream. There's been a lot of growth in the categories. Tokenized treasuries just hit $10 billion. Tokenized stocks are at $1 billion. Stablecoins obviously are still a major topic. Ondo is the leader in both the treasuries and the stocks category, so it was very nice for us to also convene all the industry executives there. But you can tell that the likes of BlackRock, Franklin Templeton, Fidelity, State Street, they're all there. They're all getting more into the space. So 2026 will be the year of tokenization.
Patrick, I want to bring you in here as well, because I would imagine another topic, Patrick, I would think, my friend, would be crypto legislation. We're trying to get it across the finish line, right? Regulatory framework, Patrick, for the digital asset sector. We seem, Patrick, to have hit a bit of disagreement here between crypto exchanges and banks. The Journal had a great write-up. I'm sure you saw it. Great reporting. The Journal, Patrick, kind of framed the central issue as, listen, crypto exchanges, they want to offer consumers payouts on the digital tokens they hold, a kind of a recurring fee. And the issue would be the fee, Patrick, it's going to be more, it looks like, than what banks could offer in terms of interest on your bank account. And so the worry from banks would be like, okay, does Josh and all his friends, do they make a move right out and into crypto? What do you just make, Patrick, of this debate, and how do you think it plays out?
This is a great question because, stablecoin legislation with the Genius Act was passed in the summer of last year, signed into law, and there's been this flood of innovation in traditional finance players getting into the space on stablecoins. In that bill, there was permissibility for stablecoins to issue rewards of some sort. Yield is the common parlance here. Now, what the banking industry, and especially the banking lobby in Washington, they were surprised. They weren't able to block the Genius Act, and so now they're taking on market structure, which is really about 95 to 97% of the value of crypto. 3 to 5% is in stablecoins, and the main part of legislating is around the larger market structure for crypto. That market structure bill is held up because the banks have activated and they want to ban rewards or undo the policy gain crypto made in the Genius Act. And so cooler heads will eventually prevail here, but it is certainly slowing down the market structure bill. And this is largely a debate by large banks and the banking lobby in Washington and the primary player with the category right now, which is Coinbase. They offer yield through holding USDC on their platform. So that is the big debate right now. That's the big coverage and the big fight in Washington. We had at the Ondo Summit yesterday, we had the president's executive director of the Crypto Council, and that's a man named Patrick Witt, very sharp, who sits at the interplay between traditional finance and crypto and is helping the White House drive policy on Capitol Hill. We interviewed him, and he is focused on getting this resolved so the president can get a bill signed before early summer. And that was the news made yesterday in our interview of him at the Ondo Summit.
Can I ask you, Patrick, though, when you say cooler heads prevail, this sounds so tense at this point, Patrick. You saw this. I mean, per the Journal of Davos, Jamie Dimon, he tells Coinbase CEO Brian Armstrong, you are full of blank. It's a family-friendly show, but viewers can fill in the blank.
Horse excrement.
Right. Yes. Yeah. Citi's Jane Fraser gave him less than a minute of her time, so Jane doesn't sound happy. Bank of America CEO Brian Moynihan tells him, this is blunt, if you want to be a bank, just be a bank, he said. If you want to be a money market fund, just be a money market fund. I mean, this sounds so acrimonious. In a prior life, Patrick, you were a congressman. You had to herd cats. You had to bring people together who disagreed. How would you do it here?
What has to happen is a law change to take away the advantage that Coinbase was able to get in the Genius Act, which enabled them to give rewards on their platform. So the current law is actually disadvantaging banks. Banks want to use the market structure bill to gain what they lost in the Genius Act. So if nothing happens, the banks are not better off. And so you eventually will grind them down and say, look, you have to split the difference between what the banks hope to gain, which is to completely undo the crypto gain in Genius on rewards, versus what Coinbase wants, and I would say largely crypto wants, which is to be able to incentivize the use of stable coins in the payment system. And so there will be eventually an outcome because the president will demand a bill. And the banks think that they have the advantage right now, but the president will demand a bill and will demand movement by both crypto and the banking industry. That is a real advantage right now. When I was chair of the Financial Services Committee, I had Biden as president. Now my successor has the advantage of Donald Trump, who's pro-crypto in driving policy. That enables a lot of movement and eventually gets Capitol Hill to take action.
Ian, a bigger picture question for you. Crypto, we know it's volatile, of course. Bitcoin, though, we are back here at about 73,000. So crypto assets are being hit. Why are they being hit, Ian? Do you think it's because some folks on the show have suggested, listen, a lot of investors say, hey, the party seems to be in precious metals, in the prediction markets, I'd rather be there. Do you think it's that? Do you think it's the regulatory uncertainty that we're talking about here? Is it both?
I think crypto's always been volatile, right? Typically, Bitcoin follows the 4-year cycle. At some point in that 4-year cycle, near the end, there's typically a deleveraging event, and after that, prices remain subdued for a while. A little bit unclear in terms of how long that lasts. We had that deleveraging event in October 10th, and since then, the crypto market really hasn't fully recovered. Liquidity also isn't back. But what's interesting to see, to your point, is that back in 2024, crypto, when the prices started to rise, crypto is being introduced into the traditional financial system via the ETFs that BlackRock, et cetera, all launched. Now, in 2025 and 2026, we start seeing traditional financial assets being introduced to crypto rails and being listed on crypto exchanges. These are tokenized stocks, ETFs, treasury funds, and the like. That is what Ondo does. And so now, for the first time, crypto kind of has to compete with some of these assets that are being listed on these crypto exchanges. And globally, investors have significantly more access to these stocks, to gold, to silver, to metals, et cetera. And so I think that creates a new dynamic that crypto hasn't really had to deal with before.
When we talk about tokenized security, Ian, my dad's listening right now probably. He has no idea what you're talking about, just none. If you were to explain that to Andrew in plain, simple terms, we mean a security represented by a digital token on a blockchain. What's the benefits of that?
Well, the moment you put a token that represents a traditional financial asset on blockchain rails, you get all the benefit of that new infrastructure. That means that you can move these assets around 24/7. Right? Imagine that you could transfer the stocks that you hold right now in your brokerage account immediately to your Coinbase account or to another type of wallet, and they would just arrive instantly. You can, as a result, take better advantage of different margin rates on different platforms. You can freely transfer them globally to someone else as a gift. There's a lot of benefits that you get the moment you tokenize because then these assets live on crypto rails. It's very similar to the benefits that a stablecoin gave for cash. Once you tokenize stocks, ETFs, and the like, you get those same benefits. You can send them globally, use them 24/7, list them on crypto exchanges, trade them 24/7. All that stuff's not possible with normal stocks.
You see, if my dad was listening, now he knows. Now he gets it. Ian, thank you. Patrick, Ian, thank you as well, sir. Appreciate it.
Thanks for
Great to
having
be
me.
with you.
Coming up, we're breaking down the recent market volatility and how options is playing a part. Now time for today's trending tickers. Brooke DePalma is here with me. We're going to start here with Apple. At least for today, investors don't mind that the company doesn't have much exposure to AI. A good piece in Bloomberg, Brooke, saying investors increasingly view Apple as an oasis of safety amid fears of AI disruption. Of course, we just heard Apple's earnings results. That was last week.
Yeah.
Record quarterly sales, better than expected forecast.
Yeah, and if you take a look at the YF Interactive, where I'm looking at right now on my screen, is really you see Apple kind of stand out in this sea of a bit of a mixed picture. You see NVIDIA, Google, Amazon, Meta, Tesla, Broadcom, Micron all selling off today. Palantir and AMD down double digits here. And then you have Apple. Apple up nearly 3%. Now keep in mind, year to date, the stock is up about 2%, but largely an oasis based upon the fact that not only is it, yes, they're getting into this AI game, they're increasing their Siri take with Google Gemini, but on top of that too, that foldable iPhone, those iPhone sales last quarter hit record highs, and there's lots of momentum on the street about what exactly this company can do with tailwinds moving into 2026.
Next up, Silicon Labs, the company getting acquired by Texas Instruments in a deal valued at $7.5 billion. Bernstein's Stacy Rasgon, very smart analyst, that's Stacy, friend of the show. Here's what he told his clients, is at the end of the day, the deal is small enough that it won't do any damage regardless of what happens, and we can see the overall fit. That being said, Stacy says, we still aren't sure we really like it given the expense, minimal upside, and what it might signal regarding shifts in strategy going forward.
Well, certainly what we're seeing in terms of the stock performance today, Silicon Lab up about 50% on the back of this news, but Texas Instrument investors, not sure how to feel about this one. Mostly flat, down about 0.7% as we make our way towards the close. With the CEO kind of banking over at Texas Instruments, largely saying that this will allow the company to accelerate, saying that this transaction will add about 1,200 additional products, and also projects that more than $450 million in annual manufacturing and operational synergies will come through over the next few years. And so Texas Instrument investors sort of waiting to see how this all plays out.
And finally, Yum Brands and Yum China. Brooke, people are loving their Taco Bell, both in the U.S. and China. Both companies reporting earnings earlier today. I saw with Yum Brands, they reported an EPS for fourth quarter that missed consensus, it looks like. Top line beats. The pressure was at Pizza Hut. Taco Bell, though, it looks like keeps beating sales, as it should, because it's delicious.
Are you a big fan?
Who isn't?
I guess he is. I mean, what we're really seeing here is Taco Bell continuing to hit the mark and what investors are looking for, particularly here in the U.S. And we heard on the call today from CEO Chris Turner that transaction growth across all income bands and more higher income consumers came to Taco Bell this past quarter. They also said that they have higher growth between 18 to 24, somewhere that other restaurant chains have really been struggling with. And then take that on top of Yum China. If you take a look at Yum China, though, outperforming today's stock performance when it comes to Yum Brands here in the U.S. And Yum China just continues to really hit the mark when it comes to innovation and price point. Joey Watt, the CEO of Yum China, is saying in a release today that their fourth quarter performance really capped off 2025 on a high note. And that largely is because of the performance that they're seeing within the KFC brand, which Yum Brands here in the U.S. has really struggled with, but around their pricing strategy and innovation, they have around 600 new or upgraded items annually over there at Yum China. I mean, the innovation is just absolutely wild. I'm dying to get there.
Brooke, thank you. Appreciate it. From earnings to geopolitical risks, there is plenty of potential volatility drivers for options traders. We're dissecting what investors should consider when approaching their trades in the options pit, sponsored by Tasty Trade. Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets, joining us now. Amy, it is great to see you. So you ask an important question, a good question, as you always do, Amy. What is something you ask that the market is underpricing or mispricing? What's the answer to that, Amy?
You know, we talk a lot about geopolitical volatility potholes, but what is interesting is if you've looked at how the market has behaved, it's been pretty well behaved with regards to Venezuela, with regards to other geopolitical risks that have occurred. One reason is because from an execution perspective, they've been okay. And so one question investors have asked us is, what if something occurs that is not well executed, that there is damage, that there is collateral? Then what do we see from volatility? Will it be less behaved in those circumstances?
Last time we talked, Amy, you talked about these trends of democratization, the rise, the popularity of retail option trading. How have those themes, those trends developed, Amy?
You know, they've been absolutely tectonic. And especially in options, you know, there's so many different things you can point to. Is just the anniversary of the meme frenzy. And one thing we talked about was we sort of saw in the gold and silver complex, you know, an area that it's somewhat unexpected, but you saw that exuberance, all that call buying, that momentum, that demand. I call it the YOLO, the MOMO, and the FOMO. You know, you're seeing this in pockets of unexpected areas. We only think that will continue further as retail becomes far more part of the picture of the stock market in general.
You mentioned those precious metals, gold and silver, Amy. So Barron's had a piece today. Metals are acting like the new meme stocks. That was the headline. What are the option markets? What are they saying about these recent moves, Amy, in those metals? And what do you see ahead?
Yeah, it was really striking because, you know, we think of it more technically. We have quantitative indicators. For instance, you know, how much call demand is there relative to put demand? What does that look like on percentile basis? Does that tell you there's more chase or not? And what I think is really interesting is although we have had that drawdown, if you go back and look at the footprint, it kind of tells you that people are still pretty exuberant on it. I think part of that, you know, there's some valid fundamental reasons. It tends to be your knee-jerk geopolitical hedge, among other things, but that doesn't mean that it is devoid from kind of the frenzy you saw during the meme frenzy. We still see that continuing. We still see that footprint specifically in the options market.
Let's talk about the software stocks, Amy. This has been front and center for investors. They are just getting mauled here with the threat of new AI tools. I think investors seem to be saying, listen, it's moving so quick, I can't choose winners and losers, so I'm gonna bail, I want out. If you look at the IGV, the software ETF, I mean, we basically, when you look at that chart, we've done effectively a round trip here back to the April lows. What are options saying about software?
Yeah, it's incredible. You know, some of the conversations I've had today, investors will admit to me, oh, you know, probably IGV, probably software is oversold at this point. And then I say, okay, well, are you stepping back in? And they're like, no. So that gives you some sense of like where we are in terms of length and positioning. Right now, the options, you know, are kind of meh. Like the reason I described it as that is it's not giving you clear directionality. It's not saying people are ready to dip their toes in yet. I think when you get these knife down scenarios, when you get these huge divergences between tech volatility and volatility of everything else, people have learned to just kind of step away from the train and wait for the dust settles. I don't think that means we won't see directionality soon. We just haven't seen it yet. I think we're in the midst of the mayhem.
Another one, Alphabet. Let's talk about that, Amy, because that is reporting earnings, obviously, just after the bell today. Stock's been, I mean, this is just a remarkable ride. The story of Alphabet is kind of remarkable. A year ago, Amy, if we were talking on this show, the story about Alphabet was here comes Sam Altman and OpenAI and Google search, this company's bread and butter. Forget it, it's over. Now look, I mean, we were up around 80% in the last 6 months, Amy, heading into this report. And even now, I'll just add, nearly 90% of analysts who are paid to tell you what to do with this stock, even now, they say, yes, buy it here. What are options saying about Alphabet earnings?
I'll tell you two things. First of all, it's implying about a plus or minus 6% move. That's like a little bit rich to the 8-quarter historical average, was about 5.5%, but I'd say it's actually pretty fair. And the second is usually you get directionality one way or the other. So either there's sort of a lean towards bullish or bearish sentiment. I'd say that's pretty low right now. So there isn't a great demand for hedges, which I think dovetails with regards to kind of the more relatively bullish view across the board. Google is a name that can shift the narrative of the whole market. So we talk about how it's just been a bloodbath in IGV and in software, but kind of the AI story can turn on a dime. We've really seen that, last year with DeepSeek, a few years before that with NVIDIA, and I think Google certainly has the power to do that, if anything, simply because it's such a heavy market concentration weight.
Finally, Amy, I'll get you out here on this. We got Alphabet today, then I got Amazon tomorrow. What do you see there?
So Amazon is a similar story. I think for most people, especially because of it kind of sitting in the S&P Consumer Discretionary Index, a lot of times it's traded under, a slightly different bucket, but same thing outside of Google, because it's one of the Mag 7 names. It's going to have the power to kind of change your narrative on the market. And I think one thing that's important is we've seen this big divergence between tech volatility versus the volatility of everything else. There's actually been a decent amount of broadening out, and people have been trading that, essentially saying, we're finally getting this widening out that we've been looking for. However, I could see if these two names do well, that you're back into the trade that's heavily concentrated. You're back into the trade where how the meat is made is really only several names.
Amy, as always, so great to have you on the show. Thank you.
Thank you.
We're wrapping up today's Market Domination. Don't go anywhere. We've got Alphabet earnings after the closing bell. That's next on Market Domination Overtime.